Hey everyone, welcome back to Yuri's Box. Today's video I'm going to talk about TLT and give a quick roundup of what happened in this last week. So um, I left things off last week, last Saturday, by saying that we didn't really have much of a catalyst in in this week until the PMI release on Friday. And when it comes down to the price action of TLT, you really wouldn't see any movement until the PMI release. We got first initial jobless claims come out on Thursday, and they did print 219 for the week before, and it is consistent with again what I said in my my base case, which is that we usually see don't pay much attention to the red trend line. That's purely indicative. But in any case, we usually see jobless claims bottom sometime in January and trend up going in towards the summer. And I have well, again, my base case is that we will see that slowly continue to rise. We also saw continuing claims continue to stay at somewhat elevated levels. I mean, historically speaking, we're still at 1.87 million, which is low historically speaking, but comparing where we were back at the end of 2022, this is a level that is consistent with, again, what I was saying in my previous videos. That is, things have cooled off in the labor market, and it has become harder than it was a year and a half ago, say, to find a job. So if you lose your job, you're probably going to have somewhat harder time finding a new job, and that is kind of reflecting and the continuing jobless claims number that you see here. Again, my general expectation is to see this number trend up. When it comes down to jobless claims, the continuing and initial jobless claims, you're gonna have variations week to week. I'm not, of course, again, let me say it again, not financial advice. Of course, I forgot to say it at the beginning of the video, but in any case, my general expectation is that both initial claims and continuing claims will trend up, especially as we move closer towards the summer. Next, we got the PMI report. Now, the PMI report came in soft overall. Manufacturing beat by a hair, and services came in particularly soft, which was really the news of the day when it came out on Friday, 21st. And I highlighted a few things that I think serve as a good summary for the entire report. Like, for example, US business activity growth came close to stalling in February, as a renewed fall in services output offset faster manufacturing growth. And the section on employment fell slightly amid heightened uncertainty and concerns over rising costs. It was the first decline in employment for 3 months to represent a marked change in hiring after jobs growth hit a 31-month high in January. So we're starting to see, let's put it like this. It's the first month after the bump. That's how I called it in my previous videos. It's the first month that we see data go the other direction after the seasonal bump, as I called it, of September to January, which, if you haven't watched my previous video, just to keep things short, generally speaking, we tend to see like inflation is the best way to visualize this. Um, Around fall to the end of winter is when we typically see inflation become a bit more of a problem, which is a reflection of the fact that people will get their end of year bonus. It's the holiday season, New Year's, Thanksgiving. That time of the year is usually when people are spending the most. And this year we had other factors affect it. Tariffs are for one, definitely a factor. So we had a lot of front running of tariffs. We had natural disasters in that time frame. We had threats of port strikes in September, which again aggravated this so-called seasonal bump. Okay. Going back to the PMIs, this is a comment which I think is quite telling. The upbeat mood seen among US businesses at the start of the year has evaporated, replaced with a darkening picture of heightened uncertainty, stalling business activity, and rising prices. And this is also consistent, again, with what I just finished saying, that we are likely in a spot right now where we're about to flip from peak economic optimism that we had probably with the non-farm payroll release in the beginning of January, and inflation pessimism to a bit of the opposite. And I expect that to grow and grow more as we get closer and closer towards the summer, where growth concerns start to become a bit more prevalent and inflation kind of takes a back seat. Okay. And to finish it off, this is a comment on inflation. And while overall inflationary pressures remain muted, this reflected a squeezing of margins in the services sector as companies sought to absorb costs increases in order to offer competitive prices amid weakened demand. And this is also consistent with something I said in one of my previous videos. And I go back to my trusty quits rate. So when it comes down to the debate, okay, what is more important, inflation or the labor market? Everything is born and dies in the labor market. Because the only way you can have people chasing prices, and so companies being able to give people, pass price increases to to labor market participants, is if the people that have the jobs have a means of demanding a higher salary. Okay, so if conditions are abundant, people will act in a way that will give them more compensation. So they'll have more money to spend, and because they have more money to spend, companies know that they can get away with, generally passing on the brunt of price increases. But we're no longer in that environment. We're in an environment where it is very hard for people to find, well, I'll rephrase that. It is harder for people to find a job now compared to 2022 or, let's say 2022 or even middle 2023. And so that's just the opposite picture. You have labor market participants' compensation likely to remain kind of muted. People don't have leverage anymore in the labor market, and therefore, any bout in inflation is more likely to have a disinflationary effect. I jokingly call it disinflationary inflation, because inflation is can only really become the problem that it became in 2022 if people have a tool to at least try and keep up with it. If they don't have that tool anymore, what's most likely going to happen is just people say, I can't do it anymore. And going back to the PMI report, this is exactly what you're seeing. You're seeing companies not being able to pass costs to customers. Okay. Now, one disclaimer, we have to be completely honest. This is the flash PMI, so whenever we get we'll have to wait till we get the final reading, and then make further assessments from there. Second kind of disclaimer is this is just one data set. This is just one number, and it could very well be a let's call it a quote unquote head fake. What kind of reinforces my idea that we are indeed on the other side of what I called the seasonal bump is that you just have to look at the previous trend. I mean, I just think that the most likely thing is that this is just a phase in a much larger trend. But in order to confirm that, we'll just have to wait. What are really the consequences for TLT going on from this point on? So next week, I really don't remember if we have any significant catalysts. But in any case, what you should be looking at, given this PMI report, is and jobless claims, is kind of the potential picture for the non-farm payrolls report that we're going to get on I think it's March 7th, if I'm not mistaken, for February. Because if we are to base our judgment on what this PMI report is telling us is that at the very least a blowout jobs report is kind of off the table. Now, it doesn't mean it can't happen, but if you put everything together, you know that February is likely going to be the first month to see where we'll see potential cuts in the public sector, and you put that together with this PMI report, it doesn't really make the case for a blowout number. No, we'll be sitting here on March 8th with a with a blowout number, and we'll happily be walk back that statement. And as far as the unemployment side, you really have to pay attention to initial jobless claims. If you see initial jobless claims just kind of, not do much and stay around these levels, best case scenario, you see it flat. If we do see it slightly move up, say between the 220 and 230, you could start making the assumption that we're going to see unemployment tick up by a tenth, maybe 0.2% in the upcoming jobs report, but I'm not really expecting anything drastic. But in any case, unemployment being steady or going slightly up, accompanied with a not so rosy, potentially not so rosy jobs report, is definitely a tailwind for TLT. And the biggest hurdle TLT has right now is kind of trying to build out a base and try to break out from this trend line we have going on from the middle of September. If we manage to close above, ideally also above the bull market support band, that would be a further indication of the fact that my assumptions on the bonds from here on, at least until the summer, would be somewhat correct, and that this indeed would be the secondary low that we were looking for in TLT. Because again, if you haven't watched my previous video, I pointed out the fact that TLT has a passion for putting in double bottoms before having a significant rally. And the two examples I like to point towards are 2008. Okay, so 2008 we had a low and then a slightly lower low before having a significant rally. Or 2010, the second example, where we've had a low and then a slightly higher low. If we get somewhat negative news on the jobs report in March, it could be an indication that we're looking towards a potentially 2010 example, and so we won't end up sweeping this low and going towards $80 again. And one last thing, I just wanted to point out also a really good way of tracking the initial jobless claims is that you should watch the Macro Edge on Twitter. They're a great profile, and if I'm not mistaken, current levels of layoffs are about 120,000. I'm glad I remembered to give them a shout out, because I have also linked their profile in the description below, along with other profiles. But if you're looking for people that talk about the labor market and general macroeconomic data, I think they're one of the best profiles, best accounts that definitely paint an accurate picture. So I think I'll leave it at that. Again, the moves and swings in between weeks can be misleading. Just keep an eye on the data. Don't stress it too much. Don't overcomplicate it too much. Again, I do have my eyes still on this, but I'm honestly not banking on it, because I think that the time to make that move was probably at the peak of the economic optimism, which we had in January. And again, we could easily just go down again on some random piece of news. I'm definitely not going to say that can't happen. But I mean, this report we saw on Friday was, definitely, generally speaking, it went in the other direction. So the best we can do is wait and see. I'm expecting again that directionally, okay, just bonds to slightly go up, and I wouldn't be surprised also if that actually acts as a tailwind for stocks. One curious thing before I end the video is that you could easily make the argument that, and in fact this is I would say my base case is that from here until the summer, rates going down will be probably a positive for stocks. And you'd expect that to kind of play out this week, okay? Because a not so hot report basically means, the Fed's going to cut, or at least probabilities for rate cuts come back online. But you actually had a return to the good old bad news is bad news playbook. which is curious because again, it goes to add fuel to the idea that we might be slowly rotating towards growth worries. And generally speaking, whenever growth is a certainty, so I'll say a year ago in 2023 especially, good news would be bad news because the economy is so hot, and it would just push out rate cuts and just keep the fear of rate hikes present. And bad news would be good news because, of course, it would just push the Fed away from rate hikes and just maybe make them consider, potential rate cuts. So it seems as though that we might be already there, but that's, I think, pushing it too much. We definitely have to wait a bit more for that. Another cute thing you could look at, and I promise this is the last one before I finish the video, is the yen. We've seen definitely some yen strength in the past weeks, and actually there's a very nice correlation between the yen and TLT. You can't really see it here. Probably this is probably the worst way of looking at it. Actually, I should probably bring up the probably the 30-year. Okay, so again here in the purple. Let me just take away the bull market support band just so you can see it better. Again, the 30 years in purple. The rest is the yen. Just keep an eye on the yen because whatever the yen does, especially, yen strength typically, kind of calls into the theme of possibly lower US growth. So again, just keep everything in mind, and the best thing you can do, I know, is the most boring thing, which is wait and not jump to too many conclusions, because we've definitely had data kind of go all over the place ever since last July. So I'll wrap it up there. Thanks for watching, and I'll see you next time. Bye.